Welcome, curious minds, to the deep dive. For years, the digital asset world has often felt, well, a bit like a financial Wild West, hasn't it?
It certainly has,
Yeah.
especially when you talk about stablecoins.
Right, these digital assets trying to be both groundbreaking crypto and, well, stable, which sounds like a contradiction sometimes.
Uh-huh.
But today, we're diving into something really big, a landmark event aiming to bring maybe some serious order to that chaos.
You're talking about the Genius Act.
Exactly. The Guiding and Establishing National Innovation for U.S. Stablecoins Act, signed into law by President Trump just now, July 18th, 2025.
And it's being framed as much more than just, another piece of legislation.
For sure. Proponents are calling it a profound attempt to tame this new frontier, cement American influence. And it's got potentially huge implications for your money.
Definitely something people need to understand.
So our mission for you on this deep dive is simple. We want to be your shortcut. Help you get truly well-informed on what's, frankly, a complex and super fast-moving topic.
We'll peel back the layers, look at the details, maybe some surprising facts in there too.
And figure out what the Genius Act really means for you, the listener. So let's get straight into it.
Okay.
So right at the heart of this act, stablecoins. But maybe we should start with the basics. What exactly are they?
Good idea. Because they're quite different from, say, Bitcoin, right? The ones everyone knows for being so volatile.
Yeah, those wild price swings. Stablecoins aren't like that.
Not by design, no. What's fascinating here is that stablecoins are essentially digital tokens built on cryptographic tech, but their value is designed to be pegged or linked to a more stable asset.
Like the dollar.
Overwhelmingly, yes. About 99% of their total market cap, and that's huge, over $250 billion now, is pegged to the U.S. dollar.
Wow, 99%.
Yeah. So their whole point is stability. It's a completely different goal compared to assets like Bitcoin or Ethereum.
Okay.
And maybe just to clear this up right away for everyone listening, this Genius Act, it's got nothing to do with that other proposal. The Stable Genius Act.
Oh, right. The one about presidential medical exams.
Exactly. Totally unrelated. This is purely about digital finance, digital money.
Good clarification. So these digital dollars, why do they actually matter in the real world? Why should you care beyond it being, some crypto thing?
Well, they act as this really crucial bridge. They connect that new world of distributed ledger technology, DLT.
Which is the tech behind crypto, basically.
Right, the underlying tech, they connect that to our traditional money system, the fiat currency ecosystem.
Okay, a bridge. And how are people using them?
All sorts of ways. Trading other crypto assets, that's a big one. But also increasingly buying actual goods and services.
Really? Like everyday stuff?
Yeah. I mean, companies like Stripe, they now let businesses accept payments in stablecoins. And PayPal, they even offer yield on their own stablecoin.
Interesting. So it's moving beyond just the crypto traders.
Definitely. And what's really compelling, maybe less talked about, is how they're being adopted in countries facing high inflation.
Places like Argentina, Nigeria, Turkey. I've heard about that. Yeah.
Exactly. For people there, stablecoins can offer some real insulation against their local currency losing value. It's almost like a digital safe haven.
Access to dollars, essentially, but digitally.
Precisely. And that ties into financial inclusion, too. Offering access to the U.S. dollar globally, maybe even for people who don't have a traditional bank account.
That's a powerful idea.
It is. And think about cross-border payments.
Yeah.
Remittances, sending money home.
Oh, yeah. The fees on that can be brutal.
They can. So sending, say, $200 from the U.S. to Mexico might cost you nearly $10 the old way.
Right.
With stablecoins. It could be as low as $1 or $2. And that doesn't really change much with the amount you send.
Wow, that's a huge difference. That's real money saved for people.
It's massive.
Yeah.
For someone sending money back home, that difference could literally mean covering rent or, putting food on the table. It shows the tangible impact these digital currencies could have.
Okay, so with all this growth, this potential,
Yeah.
It really sounds like getting some clear rules of the road became, well, unavoidable. Essential even.
Absolutely essential, yes. Given how fast stablecoins grew and the fact that oversight in the U.S. was historically just fragmented all at the state level.
Right, a patchwork system.
Exactly. So a clear federal regulatory framework became urgent. The sheer scale, we mentioned over $250 billion, and the global reach. It just demanded a unified approach.
Before this act, it was just state by state.
Largely, yeah. And with the market cap soaring like that, you can see why Washington felt the need for a comprehensive federal strategy was undeniable.
Okay, so that sets the stage perfectly. Let's dig into the act itself then. Walk us through the nuts and bolts. What does the Genius Act actually do?
Right. What are the critical pieces the listeners need to grasp?
Yeah, because everyone's calling it landmark legislation, the first comprehensive federal framework just for payment stablecoins.
That's the key distinction, payment stablecoin.
And it had quite a journey through Congress, didn't it? Passed the Senate back in June.
June 17th.
Then the House, pretty strong vote there, 308 to 122 on July 17th.
And then signed by President Trump just the next day, July 18th. It was definitely a bipartisan push.
Yeah, President Trump called it a great big beautiful bill.
Indeed. Although, it's probably worth noting, even with that bipartisan support, it wasn't without some very vocal critics, people who saw parts of it very differently.
We'll definitely get to the criticisms. But first, the core provisions. What does it lay out?
Okay, first up, definitions. The Act gets really precise about defining payment stablecoins.
How so?
It says they are digital assets intended for use as a means of payment or settlement. They have to be redeemable for a fixed amount, and crucially, they have to maintain a stable value.
So designed not to fluctuate wildly.
Right. And importantly, it explicitly excludes algorithmic stablecoins from this definition.
Ah, learning from some past failures there, presumably.
Like
the Terra Luna?
Exactly. Big lesson learned. And the key insight here for you is that the law draws this clear line. It says these regulated stablecoins, they are not considered volatile securities or commodities under existing laws.
That provides legal certainty, right?
Sure.
Which the industry has been asking for.
Huge legal certainty. Then there's the regulatory approach itself. How are these things overseen?
Yeah, who gets to issue them?
The Genius Act sets up a dual federal-state licensing system.
Dual system? How does that work?
Think of it like, maybe like driving.
Yeah.
You get your driver's license from the state, right?
Huh?
But if you want to drive a massive commercial truck across state lines, you need a different kind of permit, often involving federal rules.
Okay, I get that analogy. Yeah.
So, similarly, the Act allows different types of entities to issue stablecoins. You can have subsidiaries of federally insured banks, what we call IDIs.
Regular banks.
Right. Also uninsured national banks, certain non-bank companies, but they'd be under the Office of the Controller of the Currency, the OCC.
Okay.
Federal branches of foreign banks, and also state-regulated companies.
So state regulators still have a role.
They do. But there's a critical threshold. If a state-regulated issuer gets too big, specifically over $10 billion in outstanding stablecoins,
Then what?
then they have to transition to federal oversight within 360 days.
Ah, so it's a tiered system. The biggest players eventually have to answer to the feds.
Exactly. It ensures the largest, potentially most systemically important issuers face federal scrutiny.
So for you listening, this means both the big traditional banks and maybe newer crypto firms can issue these stablecoins, but they'll operate under slightly different rules depending on who's watching them.
That's right. That dual approach sounds like a pretty significant compromise, doesn't it?
It really does, trying to balance state and federal roles.
And absolutely crucial for investor confidence are the reserve requirements.
Okay, how the stablecoins are backed? What does the Act say?
It mandates full one-to-one backing for all outstanding stablecoins.
1-to-1. So for every digital dollar, there's a real dollar held somewhere.
Or an equivalent highly liquid asset. Specifically, things like actual U.S. dollars, demand deposits at insured banks, or short-term U.S. Treasury bills. Very safe stuff.
And how do we know those reserves are really there?
Good question. The reserves have to be held in segregated accounts, separate from the issuer's own funds.
Okay.
They have to undergo monthly public disclosures, so transparency is built in. And regular third-party audits are required too.
Monthly disclosures and audits, that sounds pretty robust.
It aims to be. And a really key protection here is the prohibition on something called rehypothecation.
Rehypothecation, that's a mouthful. Can you break that down in plain English for us? Is it like a bank lending out the same dollar multiple times?
That's a great way to think about it, yes. Okay. And the Act basically says absolutely not for stablecoin reserves.
So no funny business with the backing assets.
Exactly. Rehypothecation means you can't reuse or repledge those reserves. So if you hold one stablecoin, there is literally $1 or that equivalent safe asset sitting there backing your coin. It's not being lent out. It's not being leveraged.
So that makes it very different from some other parts of crypto, doesn't it? It forces a very conservative structure.
Radically different. It's a focus on safety over speculation, almost like a narrow bank structure, focused purely on stability. It also, interestingly, prohibits issuers from paying direct interest or yield on the stablecoins themselves.
Ah, so the stablecoin itself doesn't earn interest like a bank account?
Not directly from the issuer, no. That activity gets pushed onto separate regulated platforms or services.
Okay. What about protecting the actual users, the consumer?
Yeah, consumer protection is significantly enhanced too. Issuers most promptly redeem stablecoins at face value upon request.
So you can always get your dollar back, basically.
That's the requirement. They also need comprehensive disclosures about their redemption policies, any fees involved, and they have to follow strict marketing rules.
Marketing rules like?
And this is a crucial distinction for you, the listener. Issuers are explicitly forbidden from making misleading claims. They cannot say their stablecoins are backed by the U.S. government or are federally insured like FDIC deposits.
Ah, so no pretending it's the same as money in an FDIC-insured bank account. That's important.
Very important. It's private money, backed by private assets, albeit regulated ones.
That sounds comprehensive, but I know we'll get to the critics later. Some say it's still not enough, especially that lack of FDIC insurance. Is that a fair point, or is it comparing apples and oranges?
It's a really complex point, and yeah, we'll definitely circle back when we discuss the perils, but the Act does offer another vital safeguard.
Which is?
In the event an issuer goes bankrupt or becomes insolvent, stablecoin holders' claims get precedence. They come before almost all other claims on the issuer's assets.
So you're first in line to get your money back from the reserves?
Essentially, yes. While it's not FDIC insurance, your claim on those underlying assets is prioritized. That's a significant protection compared to, say, an unregulated crypto asset.
Okay, got it. What about the shady side? Money laundering, illicit finance, crypto gets a bad rap for that.
The Act tackles that head on. It explicitly subjects stablecoin issuers to the Bank Secrecy Act.
The BSA. So the same anti-money laundering, or AML, rules that banks follow.
Exactly the same. They need robust AML programs, know your customer procedures, the works, countering the financing of terrorism, CFT programs too.
And can they actually stop bad actors from using these stablecoins?
They're required to have the technical ability to do so.
Yeah.
They must be able to seize, freeze, or even burn.
Burn, meaning destroy.
Permanently destroy, yes.
Yeah.
The stablecoins, when they receive a lawful order, like from a court or law enforcement.
So for the everyday listener, this means if there's fraud or sanctions involved, this digital money isn't completely untouchable, like some might think about crypto.
Correct. It can be stopped or clawed back under legal process. It's not outside the reach of the law.
Okay. And one last major piece. Does this only apply to U.S. companies? What about stablecoins issued overseas?
Great question. The Act actually has what's called extraterritorial application.
Meaning it reaches beyond U.S. borders.
In certain cases, yes. U.S. regulators are authorized to exercise jurisdiction over foreign stablecoin issuers if they serve U.S. persons.
Ah, so if an overseas company wants to offer its stablecoin to Americans?
They have to play by U.S. rules, essentially. Adhere to U.S. AML, sanctions, and consumer protection standards.
And how does the U.S. decide if a foreign issuer can operate here?
There are specific conditions. Regulators need to determine that the issuer's home country has a comparable regulatory framework.
So similar rules back home.
Right. And the foreign issuer must demonstrate they can comply with U.S. directives, including having those capabilities to seize, freeze, or burn tokens if legally required by U.S. authorities.
Okay, that seems like a comprehensive overview of the mechanics. So we've covered the what and the why this act came about. But like you said, with any big shift like this, there are always two sides, aren't there?
Always. The promise and the peril.
Let's start with the promise. What's the biggest hope proponents have for this act? What's the upside they're selling?
The main argument from proponents is that this act finally provides that much-needed regulatory clarity.
The certainty we talked about.
Exactly. And they expect this clarity to attract, I'm quoting here, massive investment and big innovation into the U.S.
Making the U.S. the place to be for this tech.
That's the goal. It's seen as directly fulfilling President Trump's campaign promise to make the U.S. the, quote, crypto capital of the world.
And who's expected to jump in?
Well, the framework really opens the door for significant engagement from big traditional financial institutions. Think Citigroup, JP Morgan Chase. They're already exploring or even launching stablecoin initiatives.
So Wall Street sees an opportunity.
Definitely. But also major corporations,
Sure.
potentially. There's talk of companies like Walmart or Amazon exploring their own stablecoins.
Wow, a Walmart coin or an Amazon dollar? That's a big thought.
It is, and this all ties into a bigger strategic goal for some proponents.
Which is?
strengthening the U.S. dollar's global reserve currency status.
How does regulating stablecoins do that?
By requiring issuers to back their stablecoins predominantly with U.S. dollars and short-term U.S. treasuries.
Ah, so it creates built-in demand for dollars and treasury debt.
Precisely. Some people are calling this strategy crypto-mercantilism.
Crypto-mercantilism, like using crypto to boost national economic power.
Kind of, yeah. Using stablecoins, backed by U.S. assets, as a new tool to extend the reach and influence of the dollar globally, much like nations historically used trade policies.
That sounds incredibly optimistic, almost like a financial utopian vision. But are there inherent tensions there, trying to be both the crypto capital and maintain traditional financial safeguards? Do those goals clash?
That's a central tension, absolutely. How do you foster innovation without creating new risks? And beyond the geopolitical angle, the promise is also about efficiency.
Faster payments, right?
Just faster, potentially lower-cost transactions. Settling payments in seconds, not hours or days, like traditional bank transfers, ACH wires.
Which could unlock new things.
Exactly. Things like micropayments, maybe new advancements in decentralized finance or DeFi, making it safer and more accessible. Seamless payments within apps. Lots of potential use cases.
Okay, that paints a pretty compelling picture for the promise side. But this raises that important question again. What about the other side? What are the big worries, the perils critics are pointing to?
Yeah, the criticism's pretty sharp in some quarters. Senator Elizabeth Warren, for instance, has been very vocal.
What's her main concern?
She contends the bill is, quote, riddled with loopholes and weak safeguards.
Loopholes like what?
Critics point out that the Consumer Financial Protection Bureau, the CFPB, isn't explicitly mentioned in the act. And they argue consumer protections are still insufficient. Like we touched on, the lack of FDIC deposit insurance means, in their view, consumers could be out of luck if they're defrauded or an issuer fails, despite the bankruptcy preference.
Is that bankruptcy priority isn't enough reassurance for them?
Apparently not for some critics. They also raise concerns about whether the audits will be truly comprehensive for all issuers, especially maybe smaller state-regulated ones. Could that be a regulatory blind spot?
And beyond just individual consumer protection, I think you mentioned warnings about broader financial stability. How serious are those?
They're quite serious. Opponents, like Representative Rashida Tlaib from Michigan, warned that letting private companies issue these dollar-backed stablecoins could, quote, create a whole new form of shadow banking.
Shadow banking, meaning outside the traditional, heavily regulated system.
Exactly. And the fear is that if something goes wrong in that shadow system, taxpayers might end up having to bail it out.
Are they drawing parallels to anything from the past?
Yes. Strong parallels are being drawn to the Commodity Futures Modernization Act, the CFMA, back in 2000.
Which dealt with derivatives.
Right. It lightly regulated derivatives, and many argue that contributed significantly to the 2008 financial crisis.
So the worry is history repeating itself.
The fear is that the Genius Act might risk a similar pattern, that it could allow issuers maybe to invest reserves in slightly riskier assets or engage in other risky non-stablecoin activities, while potentially constraining regulators' ability to step in with necessary safeguards.
That's a heavy criticism. What about the illicit activity angle? We talked about AML rules, but are critics still worried?
They are. Anti-corruption activists argue the legislation, despite the AML rules, could still inadvertently facilitate money laundering and sanctions evasion.
How so, if the rules are there?
They worry about providing easier access to dollar-like funds for illicit actors, maybe through unregulated channels. They specifically point to what's been called the Tether loophole.
Tether being a large existing stablecoin issued overseas.
Exactly. The concern is that stablecoins like Tether, issued abroad, might still find ways to access U.S. markets indirectly, perhaps through secondary channels that aren't as tightly regulated.
So the rules might not catch everything.
That's the fear. And data from firms like Chainalysis suggests stablecoins are already, quote, the new kingpin of illicit crypto activity, apparently accounting for over 60% of all illicit crypto transaction volume.
Wow, 60%. So even with these new U.S. rules, the risk of stablecoins being used for illicit purposes remains a major concern, especially for money moving instantly across borders.
Precisely. It's a global challenge, and regulating just U.S. issuers doesn't solve the whole puzzle.
Are there other broader economic worries?
Yes, a couple more significant ones. One is the potential impact on traditional banks, particularly smaller community banks.
How would stablecoins affect them?
The concern is about a deposit drain. If people start holding significant amounts of money in stablecoins instead of bank accounts, that could reduce the deposits banks rely on to make loans. especially hurting funding for small businesses that depend on community banks.
An unintended consequence for Main Street lending.
Potentially. And then there's the apprehension about empowering big tech.
Ah, the Walmart coin idea again.
Right. Concerns about companies like Walmart, Amazon, maybe X, formerly Twitter, issuing their own private currencies. That could shift enormous financial power outside the traditional regulated banking system and into the hands of large tech platforms.
A fundamental shift in who controls the flow of money.
It could be. And finally, just the persistent issue of scams.
Still a huge problem in crypto.
A massive problem. The FBI reported something like $9.3 billion lost to crypto fraud just in 2024.
$9 billion. That's staggering.
It is. Scammers love the speed and often the irreversibility of crypto transactions. They use fake IDs, move money offshore quickly, making it incredibly hard to recover.
And do the platforms do enough?
Well, experts stress the need for much more collaboration between platforms and better public awareness. But there's also a counter-incentive, right? Some platforms might be hesitant to crack down too hard because ultimately more transactions just mean more money for them.
A difficult conflict of interest there. Okay, so we've seen the U.S. approach with the Genius Act, the promises, the perils, but you mentioned this isn't happening in a vacuum. How does this U.S. strategy stack up globally? What are other major players doing? Feels like a race, doesn't it?
It absolutely feels like a global race. And connecting this U.S. Act to the bigger picture is key. Let's look at the EU, for example.
Okay, Europe, what's their approach?
They have their markets in crypto assets framework, MiCA. It's a very comprehensive crypto oversight.
What are its main goals?
Big emphasis on safeguarding users, ensuring financial stability within the EU, and really importantly, protecting monetary sovereignty.
Monetary sovereignty, meaning protecting the euro.
Exactly. And what's really notable, in a stark contrast to the U.S. approach under this act, is that the EU is proactively developing a digital euro.
A CBDC, a central bank digital currency.
Yes. They envision the digital euro being the main form of on-chain money for retail consumers in the future. MiCA explicitly aims to prevent what they call digital dollarization.
Right.
They don't want stablecoins, especially dollar-pegged ones, dominating their economy.
Interesting. So the U.S. is enabling private stablecoins while the EU is building its own public digital currency. Very different paths.
Very different. And then you have the UK.
What are the Brits doing?
Their proposed stablecoin regulations also mandate 100% backing with real-world assets, RWAs. High-quality liquid assets held in segregated statutory trusts, direct redemption with no minimums. Sounds familiar, right?
Yeah, similar principles to the Genius Act on backing.
Similar principles, yes. But there are critiques. The UK's regulatory authorization process is seen as notoriously slow.
Bureaucracy.
Some say that. Others worry the strict requirements might make issuing stablecoins there uneconomic. And there's a perception that the UK regime is still mostly on traditional finance, or TradFi, rails.
Meaning it doesn't fully embrace the potential of the underlying DLT, the blockchain tech?
Potentially missing some opportunities there, yeah. Also, while the Genius Act found that workaround for yield with affiliate rewards, the UK proposals generally prohibit paying interest on the backing assets directly.
Another key difference. So it seems like while there are common threads globally recognizing stablecoins, wanting full backing, consumer protection, AML rules.
Right. Those are fairly consistent.
There are also these significant divergences, especially on CBDCs versus private stablecoins and these different takes on monetary sovereignty. What does that mean for actual usage? Can these different stablecoins work together easily across borders?
Those divergences pose pretty significant challenges for seamless global interoperability.
Meaning?
It means we probably won't get a single unified global digital financial highway anytime soon. It's more likely to be a series of interconnected but still distinct digital roads. Each country or region with its own rules, maybe its own tolls.
Which could make cross-border transactions more complex than the simple promise suggests.
It certainly could. Navigating those different regulatory landscapes will be tricky for businesses and users.
This has been a really fascinating deep dive. So the Genius Act is clearly a foundational step for the U.S., but it's not the end of the story, is it?
Not at all. It's really just the beginning of the implementation phase.
Right. Its full impact, how it actually operates day to day, that depends on the federal agencies now, doesn't it?
Exactly. The Federal Reserve, the OCC, the Treasury Department, they have to issue detailed regulations based on the Act.
And there's a timeline for that.
Yes. They're expected to get those detailed rules out within 180 days. With full operationalization of the Act anticipated, realistically, by early to mid-2026.
So still a little way off before it's fully up and running.
There's work to be done fleshing out the details.
And you mentioned this isn't the only crypto-related law being discussed. It's part of a bigger picture.
It seems to be, yes. Part of a broader, maybe more coordinated focus on cryptocurrency regulation now.
Like what else?
Well, there's the Digital Asset Market Clarity Act, or Clarity Act, that aims to clarify the old question of when a crypto asset counts as a security versus a commodity.
Ah, the Howey test stuff. A big legal gray area.
A huge one. And then there's the Anti-CBDC Surveillance State Act.
Anti-CBDC?
Yes, that bill aims to prohibit the U.S. Federal Reserve from issuing its own retail central bank digital currency.
Which aligns with President Trump's stance, right?
Yep.
He issued an executive order banning CBDCs.
It does align with that position, yes.
Huh.
So you see this pattern, enabling private, dollar-backed stablecoins while simultaneously blocking a public, Fed-issued digital dollar.
A very clear strategic choice being made there. It's definitely not an isolated event, but part of a much larger strategic shift in U.S. policy towards digital assets.
Seems that way.
Okay, so as we wrap this up, what's the lasting impression you think listeners should take away? How might this big financial shift actually reshape their everyday lives down the road?
It's a good question to ponder.
Yeah, I mean, as stablecoins potentially become a more foundational layer of the digital economy, how might your own relationship with money, with payments, maybe even with national currencies themselves begin to shift? What really stands out to you about this rapidly evolving financial frontier we've been discussing?